Ladies and gentlemen, welcome to another episode of Money Talks, an exclusive conversation with some of the most brilliant minds in business, entrepreneurship, and finance. Once again, we find ourselves in beautiful Singapore, but as you guys know, I'm a person that loves the markets. I'm a big proponent of how to make your money work for you. A lot of you guys are making money. A lot of you guys have been in entrepreneurship for a few years now, but you don't really understand how to multiply your wealth or how to preserve your wealth. So today, I have the opportunity to sit down with the former CEO of Crossbridge Capital, now running his own operations, solving problems and, deal making now that he's outside of the suit and tie game and really being able to build an ecosystem that serves entrepreneurs throughout the world. Mr. Yai,
Thank you very much. Thank you for having me.
thank you so much for being here. Now, when Steve brought the opportunity of being able to converse with you, I was highly intrigued because you and I kind of share something in common. Initially is we're both international kids. So you've kind of traveled all over the world. You were in Israel, born in Pakistan. Now you're living in Singapore. So you're really well cultured, well traveled. And I was like, okay, if I can sit down with 90 minutes and pick this guy's brain, I think it'll be of value to the community. But something that you and I have in difference is you did go to university, Cornell, but you got an engineering degree. But I don't know how that necessarily translates to you being in wealth management, being the CEO of a $4.5 billion fund, which is insane. Maybe there's some insights there. And before we kind of dive into what you're currently doing, where you see the markets headed, how entrepreneurs can multiply and preserve their wealth and some strategies there, I want to take it back to the beginning. Where did it all start?
Sure. Well, I think the world was a different place when I went to university. For one thing, the internet didn't exist. In fact, if one wanted to consume information, they would have to go to the library. And then you're then beholden on the fact if the library is any good at all, which generally it is not, right? Especially where I came from. I'm from Thailand, and being Thai, and at that time when I graduated high school, I did not speak Thai. And so I was thinking, what am I going to do with my life? I'm a citizen of a country which I don't speak the language, and I don't have anything. Where am I going to go work? So university was really the only choice I had. And people fought very hard to get into university back then because it was in many ways the only exit out. There was no way to reach out to the world. There was no way to communicate with the world. It was all paper. It was
Free internet.
Cordless phones were still a new thing. Let's put it that way. Pagers had yet to really come into the picture in 1989, right?
Wow.
So we're talking about like Berlin Wall. We're talking about this is when dinosaurs roamed the earth, right? So it was a very different time. So getting to university was very important, and then graduating from university was important because universities back then was a sifting process because you had, let's say, 2 million kids graduating from high school in a year. What you need to do is there had to be this filtration process for companies and for the world to understand who is actually good and who's not.
Yes.
And universities was really the only way. So I entered into that thing, and engineering seemed to be the most expedient thing to do because it was not really language-based. It was money and technical capability. But then returning to Thailand, I found that there was no real revenue coming in from that line. And people didn't really understand, again, because of the lack of information, the lack of the internet, et cetera. So when I graduated university, I came back to Thailand, I applied for an email account. So I have one of the first email accounts at Cornell, right? And I have, and so when I went to Thailand, I could access it. But in order to get an internet line, I had to sign up to an internet provider, which was a very rare thing and a very difficult thing. And we were still signing up through.
You're an email vet.
Yeah, exactly. So people, with that lack of information, companies just did not know where I came from, what I did, or what my capability was. And I found that engineering really had a very limited lifespan, career span in Thailand. So I moved over to, I applied for a job in banking through a friend of mine. He helped me out. And I loved it. Dealing with money, you have, especially when you're so young, money is a form of power, right? And when you are in that space and you're in that arena, you're not a principal player. You're not like the main attraction in the gladiator game, but you do see the people going out there, and you do see the people fighting, and you can see the central banks, going toe to toe with the big hedge fund managers, the guys like Soros, and you see these things happening, and you see how it affects the world and the power that they wield, it's it's very easy to be starstruck and to see that you are close to where things are driving the world, and you're
The
a witness.
inception point.
The inception point. You're an audience to it at that point. Of course, I was not a big player in the beginning, but you start to see that there is something else out there, and it's very enjoyable to be actually in that fray. But they do say that people who are good in finance, especially in trading, are psychopaths, because you need to kind of disassociate yourself with normal human emotion.
Yes, for sure.
And so, I mean, I was a good trader, right? So there are people who do believe that I do have maybe psychopathic tendencies.
I mean, I'm in the same wavelength as you. Some days, of course, I don't know what your biggest wins or your biggest losses were. I want to dive into that a little bit, some stories there. But I think my worst day trade or loss was like $250,000 or 275K, and people were like losing their mind around me. I'm like, no. They're like, am I crazy here? Like, am I losing my mind? So I completely resonate with you. Tell me about a little bit of the banking era. What did that kind of look like for you?
So when I entered banking, I had a little bit of a tumultuous start. So I started in Deutsche Bank back in 1995, and 3 months after I joined, the spot trading team quit, and I was made head 3 months into my first job, without any experience and barely any idea of how to work the systems. And so I learned on the job, and it was brutal because everybody knew where I was at, and the newly formed team around me as well. And people were out to get us, and they tried hard.
What do you mean people were out to try to get us? You mean competing banks?
Yes. So trading back then was like playing King of the Hill. So it was about might is right. So what you did is you powered through positions. A lot of the ways to trade that were commonplace back then is not allowed, and it's very much frowned upon today in this day and age. But back then it was normal par for the course. So people would call in, and they would try to see if we had the wrong price. As a market maker, we were beholden to show both a bid and an offer. And if we showed the wrong price, let's say my bid was too high, they'd sell it to me and they'd buy it back somewhere else. And people tried to kill us because they knew we were young and we were green. But this is trial by fire, right? And we survived. And it was some of the toughest times I've ever been through. But I have to say that it made me extremely strong mentally in terms of dealing with stress. So we went through that, and then we did well despite everybody's thoughts. Right, we actually did very well, and our branch was topped out Asia that year in terms of revenue, and my boss and myself were transferred over to Singapore, and that's how I came into Singapore. So back then it was. Like if I had a position and I wanted it to go up, for example, I would, you could spoof the market, for example, and you could tell people, oh, look, you're buying from here, you're buying from there, and then everybody would talk, then they all get scared, and the market starts to move higher. And what you're doing is you're creating a perception, and you're creating this entire story around what you're doing. So people talk about charts. Charts are looking at it after the fact.
Yes.
What I'm talking about is creating the charts and understanding how those emotions actually do it, because charts are reflective of human emotions.
That's correct.
Right, and that's what it's supposed to be. But if you can assess the raw emotion yourself, right, then that's a very different story. For example, if you call another market maker, and back then we were trading on Reuters. So it was like a chat program. Like it was like very much like how you would chat on WhatsApp or whatever. But as you type, you cannot erase. So for every character you put in, it pops up on the screen.
It's live.
And it's live, and it's forever. It's a record. It's banking record, right? So you have whatever you type, you have to be careful what you type. And people would chat with each other. But what you do is you call each other for pricing. And when you call each other for pricing and you come back to me, I can tell from the speed that you type and what you type, what you're feeling. Whether you're having a good day, whether you're having a bad day, whether you're scared, whether you don't want to sell, or whether you don't want to buy.
Like if you're lagging, if you're holding off, if you're super excited, you're like...
Exactly. And by understanding that, then then you play on that emotion. So fear is a great driver. Greed is a great driver, right? So by playing into those emotions, what you can do is you can actually micro manipulate, but you have to do this across many, many different players. And what you do then is you create the market around you. And that's the kind of trading that I came from.
So you go from moving markets to being like, I'm out of the trading game. Talk to me about the swap from trading to running wealth management.
So in 1997, I was post-Asian crisis. I was in Thailand. So I was in Singapore, but they posted me back to Thailand to help run risk. And so I was sitting in a bar, and I was talking to this girl, and I'm single at the time, and I asked her whether she wanted a drink. So I bought her a drink, and she offered herself to me for a sum of money. And I said, "You don't strike me as that kind of person, right? How did you end up in this situation, right?" And she told me that actually she had been working in a finance company that had just recently gone under because of the Asian crisis, right? And now she was jobless and she had to support her family. And now this is what she was doing, and it broke my heart, right? And the thing was, I was trading leading up to this, and I in no way am I the cause of the Asian crisis, but
But it's a zero sum games. If you're making money, the other party's getting nuked.
I was definitely not helping. Let's put it that way. I was not part of the solution. I was more part of the problem. And I said to myself, I can't do this. I can't be a part of this. So I made the mental decision at that point that I would change. And then I said, well, I still want to be in banking. So maybe I get away from trading and I'll move towards sales, where maybe I can do some good. I mean, looking back now, that was also extremely naive, because just because you're in sales does not mean you do good, right?
True.
So it's you do have to. There are a lot of fine points to that, but yeah, that was my genesis of moving away from trading, and trading was, I have to say, I mean, I still miss it even to this day, because the adrenaline rush that you get is uncomparable.
I agree.
You cannot compare it. I mean, the kind of losses that we would experience were significant. Right?
Talk to me, without going into the details of the trade, talk to me about the most legendary, memorable trade. You don't have to go into details as to what the trade was, and then as well as probably the biggest L that you took.
I mean, there were several.
Quantify it in a dollar.
So trading is about, it's not just about the money you make, but it's about who you go toe to toe with, right? So there was a major currency. This was this is during the GFC. So the GFC, I was trading, and we were working with. So under me, we had trading and sales, and we had quite a lot of support from our clients, right? And we also were in the center of the activity in the world during GFC. So in the major currencies, and there's a central bank will trade through another central bank, right? So what they call it BIS, Bank International Settlements.
Yes.
Right. So BIS calls, then behind BIS is a central bank. It's not just a regular client. So when you know BIS is calling you for a price, you know what they're doing effectively is they're most likely intervening, right? So BIS called one day on a currency pair, and we decided that we didn't agree with their position. So we went against it. And so then,
You went against the central bank.
We went against the central bank in a major currency, and we won. Right. And so we drove the market, I think, 1 or 2%. In the foreign exchange world, that's a lot.
Yes.
Right. And so because
So we're talking billions.
Yeah. So it was like our position at the end of the day was a few $1 billion. Yes. And we moved the markets in our favor.
Incredible.
And then we got out.
So you secured the gains.
Yes. Yes.
Amazing. That's madness. So there's also, first of all, you vindicated yourself from the psychopathic tendencies because of the story at the bar. So you're good. But that's crazy. So trading is not just, like you said, it's not about the gains, but it's also about the battle of egos, of who you're going up against and who's the king of the hill.
It's very much so. I mean, the Asian crisis back in 97, I think, was caused really because central banks were ill-equipped to understand the money as how it would morphed and the size of leverage in the markets. And that caused their downfall because they thought that they had enough power. I think that this is ultimately the problem that's existing today. It's ego, and it's misunderstanding, and it's a lack of ability to learn and to try to absorb new information. So that's why we see people struggling now, right? We have why is the Fed raising interest rates so aggressively when 2-3 years prior they were pumping so much money in? I think that they're starting to lose a little bit of control of what's going on, and I think that the new tools that are available, I don't think that they're quick enough to embrace it.
Yes.
I think that cryptocurrency, for example, is a new paradigm. I mean, we can't get away from it. It's there. It's like when internet first came up, I'm sure that your audience is way too young to remember this, but Warren Buffett in the beginning was saying, internet, it's going to be a flash in the pan, right? It's not going to happen. It's just a fad, right? I mean, how wrong can you be? I mean, internet has changed the world entirely, right? So, I mean, back in the day, where I came from, is rotary phones and no pagers. If you wanted to talk to somebody at distance, it meant you had an extension cord, right? That's essentially what it boiled down
And the
to.
funny part is he's now one of the top shareholders, not the top shareholder of Apple, which is one of the leading internet companies in the entire game, which is the discrepancy. So even the top dogs of the time can be completely wrong as to what is going to be taking place in the future.
Because people aren't God. The moment you start to think that you're God, that's hubris, right? That's false pride. And what will happen is it just comes before the fall.
Yes.
You should never believe that you're better than other people. You always have something to offer. You always have something to learn from somebody else, no matter how humble the other person is, right? I think that's the game. And coming back to trading, people think it's about money. It's not about money. It's very often people who trade and people who make money and the most successful people in the world, they aren't doing it for money. That's not their primary goal, because how many billions do you actually need? The reality is you need to cover your basic costs, which is food and housing. And then maybe you get better food and better housing, but then it tops out, right? Because, how much more delicious can your rice get?
For sure.
Right? Rice is still rice at the end of the day. And if you're going from one place to another, you can drive a humble, Honda, right? Or you can be in a Bugatti Veyron. It's still getting you from point A to point B, right? I mean, there's no change in that one. So for your 10 minutes of comfort or luxury, that's what you're paying for. That's the additional utility you get as you get higher in that game is less and less.
Yes.
Right. So money isn't the thing. That's what I'm saying. So what people are driven by a lot of different things. And usually for men, it's very much, in my view, is power, right? Power is a big driver, right? And ego, another one, right? So these are the things. So when you look at the greats out there, the greats, right? You talk about, let's say, Steve Jobs, right? Or Musk, right? Is it money that drives them? No. You have to take, I mean, there are movies coming out about why these people are driven, but it's never about, I got $1 million in the bank.
Never.
No, it's never like that.
Well, it's like you were mentioning, at some point in the game, you see those guys running with level 999. They don't care about the amount of dollars or coins that they have collected.
Correct.
They're just figuring out what's the next monster that I can slay to just continue playing the game at a bigger level. You mentioned this idea of what money truly is. And money is just as good as you are in the game, you just collect more assets and you collect more things throughout the game. Tell me a little bit about kind of like your perception when that kind of shifted from, hey, I need money for survival, I'm hustling, I got to now you seeing it as a utility for enjoying the video game.
So when you play a game and your level, and so if you're playing like a Diablo or something like that, then your ranking in that game shows something. But that ranking really is only useful for other people who play that exact same game, right? So if you don't have that context, then it's a little bit difficult to translate to people who don't play that game or in different places. So in the real world, it would be like living in one country and it can explain to somebody in another country. So for example, in Singapore, if you have a Rolls Royce, okay, so let's say you have a Porsche here, right? You have a Porsche here, and then you tell somebody in the US, and in the US, it's expensive, but it's not prohibitively expensive, right? But then you think about how much it actually costs in this country, then it has a completely different meaning.
Yes.
So level 50 in one game is not exactly level 50 in another game.
Yes.
So what people then do is they're trying to say, okay, what I'm trying to do is I'm just trying to exhibit my influence by the amount of money I have. Because maybe that's another way to measure it, right? So then instead of saying, I have level 50, then it's like, I have, 10 million of gold sitting in my account. And then other people are like, I get that, right? I get that. But then I think that the world starts going around and they just talk about the gold and they forget about the game. And now it's ass backwards again, right? So I think that this has become a measurement and people are focused upon that. But I think that for anybody who's actually accumulated wealth past their first or second comfort level, they start to realize that it's not just about money. And then I think that's the first time that, especially I experienced this as well. As a kid, getting my first paycheck, and buying things like I can remember going into a store and buying a necktie. You go, I can just buy this, and I don't have to think twice about this. I can just buy this, very easy. And then 2 years later, buying 10 of them and finding no joy at it,
Yes.
right? So it's not. And then I realized, I'm feeling empty. It's not the money that's doing it for me, is it? So what is it? Then you chase power, right? And once you get that, then you realize, oh, this is empty too, right? So it is. There is an exploration of finding what drives you, what gives meaning to your life. And I think it's simple to say money, but it very rarely is. I mean, okay, that's putting.
That's level one,
That's level. You have to get there. You have to support your family. You have to eat. You have to have shelter. Like, there is nothing more important up until to that level. But once you get past that level, then you have the luxury of starting to think about other aspects.
Yes. For people that are not yet at that level, what 2023, 24, 25, what is that number? Is there a number? I'm not talking tier 3 countries, your Malaysias where it's cheap to live, your certain places in Indonesia. I'm talking your Singapores, Australia, UK, US. What is that number of stability, without going over the top, that one should look out for and be like, okay, this is my milestone. Once I'm here, of course, it's obviously an intrinsic number and it pivots, but there's still some sort of truth involved in attached to it. In your opinion, what is that initial number, that level one, that people should aim to achieve before money is no longer the driving factor for action?
I don't think it's an actual number, because I think it depends on your lifestyle. So it's equivalent of 1 million resources in Diablo is not the same as 1 million resources in another game, right? So I think I would say that we put it into other tangible terms. Let's say you have enough to live, to survive to support your lifestyle, whatever that may be, food and vacations, right? For a year and a half, right? And you have enough to support your mortgage for 3
years.
3 years.
So you're looking at a 36-month leeway
on mortgage plus. So that accumulation of wealth, that amount of savings puts you into a comfortable zone.
Yes.
Right. It doesn't make you rich, right? But it puts you into a comfortable zone that you can actually not worry about, oh, what am I going to eat tomorrow? Or can I pay my rent? Am I going to lose my home?
And I think in that discrepancy, a lot of people miss reality, which is when you had nothing, this idea of having 3 years saved up was the goal. The goal was freedom. But then you look at Instagram, but then you look at YouTube, you see the guy driving this car, that car, and you begin to redefine what it means to be success or what it means to achieve success, and you lose the whole point. So you start increasing your expenditure in the game.
Correct.
Which means you have to play the game the same way longer. So you're just a bigger rat in the same game.
100%. 100%.
Talk to me about this idea of we were talking about running a $4.5 million fund, where you're managing assets and money for all these clients. You said it was hard to get out.
I come from wealth management,
Yes.
typically, so I'm not actually one that runs money in that way. What I do is I advise. I still think that, okay, so if I'm talking about earlier about power, right? What you want to do with wealthy clients and let's say individuals is you have to give them that part of the entertainment, because it's their money and they need to enjoy it. So very often the very wealthy participate in the markets not because they need the money, but because they need the stimulus, and they need the entertainment, right? Especially when you trade foreign exchange, right? So you can't deny that. So what you don't do is you don't tell the client, hey, leave me alone for 2 hours or 5 hours or 10 days or whatever, and I'll make money for you. They will never be interested in doing that. They have to be part of the process. So you have to engage them, and you have to,
They have to feel like the victory's theirs, that the loss is there. They have to feel like they're in the battle.
They have to feel like they're in the battle. What you are is you're guiding them, right? So you're guiding them, and you're making sure that they don't step on the landmines. You're like, oh, stop over here, don't do that, right? You're supposed to be ferrying them around and helping them navigate the battlefield, right? But that's the game that they're playing. So I think that there's that. And then if it's institutional money will think for itself. So then what you have to do is you have to offer the right structures and you have to offer the right ideas, but then institutions will make their own decisions. And that's a difference between a professional and an individual that are doing these things. So it's to truly run money. I think that that's not a game that I'm interested in, to tell you the truth. I'm not interested in being a fund manager because I'm just sitting alone at the top, right? Trying to be right. And the moment I'm wrong,
Excel sheets.
yeah, the moment I'm wrong, people are going to kick me, right? It's like that, that old adage, right? It's like, if the person's lying down, what do? Well, you kick him, of course.
What else are you going to do? You're not going to pick him up. You don't win the game. You can't be the king of the hill that way.
Exactly. But I think that, you mentioned the whole rat race, right? So I remember reading somewhere, I can't remember where it was, but they took a bunch of rats and they threw them into this pool of water, and the pool didn't have an edge, so they couldn't get out. So they swum, right? And all these rats swum, and some gave up and some continued to fight. And it was based on their own natural way of thinking, like the fighters and the people who give up. Now, the humans, we're not rats, right? We're higher level beings, and we can make a decision not based on our DNA only. We can actually make conscious decisions that actually change the way we live. So even though we might have an urge to do something, or let's say we are driven by certain things, like you have a gambling instinct, or you love power, or you love, like, we don't have to be only driven by those things.
You're not defined.
You don't have to be defined. You can be. You can just go back to your lizard brain and be that person. Sure, that's a choice, but it's a choice. Like, if you decide to do something else and elevate yourself above it and be more than that, you can also do that, right? And so then this is where, this is, I think, what separates people from animals, right?
Do you think that, because I want to talk about that transition point about the rat race, where you're like, it's hard to get out of the rat race because I'm making so much money. Like, I'm doing extremely well.
Correct.
I have everything that I need. I'm absolutely crushing it. I'm the CEO of a multi-billion-dollar wealth management company. Like, I'm doing great in the perception of reality. But you mentioned something, I didn't enjoy it. Talk to me about, what's the transition phase look like, where you look at yourself in the mirror and you're like, all right, this thing that a lot of people would kill for, right? You're just like, all right, on to the next one.
Well, it comes in, I don't think it's a single step process. I think it's a multi-stage process. What happens is, very often when you start your career, you earn good money, and then you get into overspending, and then you hit some adversity, and then you find out that your spending has outstripped your actual means, and then you end up in trouble, and then you have to fight your way back. And then sometimes you make investments, and those investments go under. And again, you go through this period. So it's this peaks and troughs that you go through. And I think that is a tough part. I remember when I walked into the trading room when I first started working, and this trader told me, listen, it's not whether you win or lose. It's not whether you win. You take this trade and you make money, that's going to define whether you're a trader. It's how you lose. Because the way you act when you lose defines your personality and your fortitude, right? Because let's say your foreign exchange is up or down. So you don't know anything about anything, pick a side. You have a 50-50 chance. Does it mean that the 50% that actually chose right are actually good traders? Absolutely not, right? You have to go through that loss phase. And when you go through that loss phase, then it defines you. Because again, like, having money, like, okay, so then the first part you get, okay, I live in a one-bedroom, I live in a studio, it's in a nice place, it's not crime-ridden, but it's nice, right? And I earn enough to eat decently. I can take a vacation once a year. That's your basic, I think, in my view. And it's not luxurious, right? Nowadays you can actually dress quite decently and not spend a ridiculous amount of money. In fact, I think that the wealthier people I know are dressed down, right? They don't dress up. Like, people don't walk around in $1 million watches because it's embarrassing. Right, so we're kind of, it's frowned upon to do that, and so then it's not necessary to spend that kind of money until you get into it, because then you start to overreach. Then I want a 3-bedroom apartment in the best part of town, the penthouse, right? I want to drive around a Rolls. I want to have a driver, right? I want to have 2 cars, right? I want to have 2 cars because I can not drive more than one at a time, so I want 2, right?
Half a body in each.
Exactly, right? So you start to get into that, and then what happens is you start thinking that that's important. But when you lose it, you lose that first revenue stream, then you start to have to scale back. Becomes really painful. I remember, I used to drive to work, and then at one point, it's like one of my adversity points, and I'm like, then I had to take public transport, and the first day I was like, oh, this sucks. But then after a while, then I was like, this is so much better than driving, and I don't drive anymore. I don't like to drive. I like to sit in the bus. I like to sit in the train, because then I get some private time. I can read things, and it's like you get to see the people around you, and you're not so disconnected from everybody. So this fallacy of thinking that you're better, and this comes with youth, and this comes with more money as you get in your youthful years. This pride and this hubris, right, which I think is completely misplaced. So we have to get away from that, and I think that it's that up and down again that brings you there. So it's how you manage it. So you need to go through these different phases, and you need to understand it's a process. Life is not about a single line. You don't have a single line to your goal. In fact, very, very few people live that way, unless you're talking about death. Yes, we are all on a single line process to death, right? So we all know that, right? But if you're talking about success and wealth, which are not necessarily defined by money, then these are very different things, and it's a journey. And so you have to understand that this journey will take a long time, hopefully, right? We'll all hopefully last a long time and grow into our old years. And what we want to do is have that chance to do it again and again and again and again. So you can't burn out in a year. You should not look to enjoy yourself and do everything, because otherwise you end up, with a needle in your arm in a street in Bangkok, right? You can burn out like that.
You need to run the marathon.
That's right.
In Capital Club, our motto is create, multiply, and preserve wealth. Wealth, by definition, isn't money. It's abundance. Abundance of health, abundance of relationships, abundance of a clear mental state, abundance of finance. But Naval Ravikant, are you familiar with Naval?
No.
So Naval is this thinker, angel investor. He has a really good book called Almanac. And inside the book, he says, so I think it's quoted from one of his tweets. He says, the person that lives under their means experiences a level of peace that those that live above their means will never be able to experience. Is that something you agree with?
Absolutely. Because once you have that peace, once you have that serenity to think that way, then you can actually move on to other things. Then you can enjoy things in a completely different way, right? Because you're not just worried about getting your next meal, right? You're not just worried about surviving, and you start thinking that, right? Oh, I need to pay my mortgage, right? Well, if you lose your house, but you can still pay rent or something, you still have a roof over your head, things are not really that bad, all right? You don't need that, that multi-million-dollar house and that penthouse in Beverly Hills or whatever it is. Is it really necessary? Absolutely not. So once you get past that, and you're like, oh, poor me, I cannot eat in a 3-star Michelin restaurant every week. Like, oh, woe is me, right? But there are a lot of people that think like that. Once you scale back from that and you start realizing that food is food, and you can enjoy a great meal for significantly less money, right? Then you start to enjoy other things. Now you get to look around. You get to enjoy your family more. You start realizing that your friends are important, and you start thinking about doing other things. Because, like, for me, I delve great satisfaction from building. Like seeing things that you can do together, especially with a group of friends, right? When you do it with a group of friends and you work towards building a project up or a company up, or bringing value, right? And bringing real value to other people, and you have longevity, and you're supporting their families, because the money that's being generated by this company is paying for their families, and therefore keeping them alive and doing all these things, right? Then of course you make money through this, but that's not what you're thinking about, right? And that's not where you're deriving your satisfaction from. You're deriving the satisfaction from actually being part of the system, by being part of the ecosystem that is actually supporting other people and not just robbing it.
You talk about being a node.
That's right.
And when we were talking about, I was like, okay, now you transitioned out of wealth management, whether it was sales, but you're still part of the company, to being a node. Talk to me about the importance, before we get into what that looks like practically nowadays. Talk to me about because you mentioned once you provide value, the money comes.
Mm-hmm.
And people think that the only way to make money is by extracting value, whereby I believe that if you create an ecosystem, money will come to the ecosystem as long as the problem that you're solving is one that's worth monetizing, but you can be a strong node. We were talking about Bitcoin, right? The more nodes that Bitcoin has, the stronger the network becomes. And you mentioned, I was like, what are you focused on nowadays? Well, I'm just a node. Talk to me about what that means.
All right, so let's put it in very simple terms. Let's say you're running a sales gig, right? And so especially bankers who are in their initial years in sales, they will be experiencing this. So they're on pressure to actually sell X amount of volume of a product. So in $1 million, they sell $1 million, and their commission, the bank's commission, let's say, is 2%. So it's $20,000. Out of the $20,000, then that particular banker might earn $200. But this $20,000 that they extract from this $1 million from the client money erodes the quality of the product significantly because it's taken on day one, right? My thinking has never been like that. My thinking is like, you take your $1 million and you don't charge anything, but you turn and okay. So if I wanted to take a look in day one, how much could I take at max from that $1 million? Well, I can take $1 million, right? I just rip the guy off. I take everything. I take $1 million. Now, but if you take that $1 million and you turn it into $10 million, right? Now, the max profit that you can actually make is 10 million. Like, of course, we're not talking about stealing everybody's money, but what we're saying is that the potential for making money is much more if the client also makes money. And that is key to this entire thing. Because if you turn 1 into 10 and you take 1 million, which is what you could have taken on day one and just ripped the guy off, he ends up with 9 million. He's made $8 million. Chances are he's still extremely happy and he will not complain. Whereas if you take 20,000 on day one, that client is going to be extremely irate, even though it's a much smaller number, right? So what we need to do is we need to move towards that kind of thinking where we're all pulling in the same direction. And so being a node is really about that. What you're doing is you're connecting people and you're protecting them from the outside elements. So being a node, you're connected to, let's say, one set of points, right? And you're connected through you, let's say you're connected to another set of points. What you're going to try to do is protect both sides from each other. It's not a pass-through, right? So it's about doing the checks. It's about doing the provenance of the people that are being pulled in. It's about the quality of the companies that are involved. You have the legality of everything that's there. You know, what you don't want to do is do a deal and expose everybody to legal risk, right? That's the whole point of having this. So connectors or nodes are in the network are I think extremely important because you can never learn, you can never do everything by yourself. I mean, in this information age, it is possible to get a lot of information just by pulling up Google. Yes.
But the execution of the information is not possible.
Yeah, it's also very hard to consume. So if you want to, you want to learn accounting from the internet, it'll take you a long time. But if you had somebody sit down next to you, they could probably teach you everything there in a much shorter period of time. So I was pretty late in the crypto space, right? So I came in the beginning of 2018, and so over Christmas on 2017, a friend of mine told me, "Listen, you need to do this. Please understand this for me." And I'm like, "Fine." So I called up a friend of mine and I say, "Hey, listen, I need to understand how this whole crypto thing works. Can you refer me?" So he made connections. He was a node. Right. Then he made the connections. Then I called one person and I called another person. And then he introduced me to another person. We were having conversations. And 3 months later, I was on stage in a Bitcoin in a crypto conference.
Very interesting.
So it moves quickly, right? And I think that what I really like about the crypto space is that, well, less now, but more so in the beginning, it was a very helpful community. Right? There was a very open community that people were just, open-hearted and like, "Oh, you're hungry? Please, I'll open the door, come in, have a meal," right?
It was more so about learn what crypto is as opposed to now it's very much money, 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 money.
That's right. So it's as people start losing sight of it, right? But it's not really about that, because the whole ICO process, of course, it was really about stealing money, right?
Wild.
Yeah, but very few. That's why the adage was, a solution to a problem that we don't have. But there are solutions that are needed to real problems, right? And now it's coming to light, and this is where I think that we have the longevity, right?
You have some involvement now with crypto, or some thoughts, not necessarily with the markets, blockchain, but you were talking about off-ramping and the importance of establishing this relationship between the crypto space, but also with your ability to pay rent.
That's right.
Right. And yeah, as much Bitcoin as you have, these people, when it's a bear market, may not be enticed for you to pay your rent with Bitcoin. Yeah, you get an article now and then that says, hey, this guy bought a house with Bitcoin, whatever, X, Y, and Z, but it's not the normal process. What is your opinion? Where do you see the crypto market? Where do you see this idea of off ramping? We were talking about the US is getting absolutely just nuked from the inside out when it comes to off ramping. Things are getting shut down left, right, and center. Binance getting sued, exchanges being taken down, exchanges calling bankruptcy so they don't have to deal with any nonsense. Where do you see the space headed? What are your opinions?
It's funny because actually I got into, so in 2018, as I started working in the space, the challenge was really on and off ramp. And then up until last year, a lot of those concerns were eased, and people were having a lot easier time getting on and off. And now it's become difficult again. So now we're at again at the trough part of this cycle. So look, I mean, it is important to spend the money you have to get the basic needs that you have, and there's no point in having widgets if you can't convert them to dollars in order to buy food, right? You need to have the ability to move back and forth between the two. So on-ramp and off-ramp are important. The number of institutions that are offering it are few right now, but what will happen is that it will grow again. So the SEC is clamping down hard. But in my opinion, they're not really trying to shut the industry down. What they're trying to do is stop another FTX embarrassment, right? And so Silicon Valley Bank, they screwed up because their treasury management was poor. What they did was they needed to place their deposits out and earn some yield, and so they screwed up as a bank. So there was a communication issue, I think, that happened in the U.S. because Silicon Valley Bank didn't really need to go down, right? And so then that was part of the cascade of things that are happening. So it will reveal itself, but there are ways. I mean, so if there are people that are looking to address that particular need, right? We have people within our network, through your club, right, and through the users that you have who are also nodes that can actually identify and fix this problem. So I use a trust company in Hong Kong. There are other people that are doing things. The emergence of stablecoin, for example. So stablecoin, there used to be a bunch, now there's less, right? And there's always going to be mess. But the trust company, for example, I'm working with is launching a new stablecoin. So, and Hong Kong is getting a little bit more easy, right? So certain jurisdictions will get easier. So now Dubai, for example, is quite crypto friendly, and Hong Kong is looking like it's doing that. Is it always going to be the case? Probably not. Things change, right? But then what you have to do is you have to move with the times.
I want to ask you about the USDT concept, and then I want to talk about moving with the times and we talk about liquidity in the markets and money kind of being liquid and money moving, but you also have to be liquid. So you can't be fixed in your kind of mentality and your framework of how things are. You mentioned, I talked to you about, hey, I have X amount of my money in stable coins, USDC, USDT, but at the end of the day, these guys are out here buying treasuries, they're out here making sure they're getting yield as well on their money. And we saw with the Silicon Valley Bank that a certain amount of their deposits the USDC's deposits were in that bank, and therefore there was a depegging. It was like a wake-up call, because at the end of the day, you're like, okay, these stable coins that are supposed to be stable, they're only stable if the traditional market is stable. So is there a true discrepancy, and are these two worlds actually separated? And in fact, they're not. But you mentioned something about USDT, a data set. I call data sets, little downloads of information from the universe that give you clues as to how to play the game in the future. Give me your understanding of stable coins and when they become a risk versus where they are today as a potential safeguard for fluctuation in the crypto market.
All right, so there's stablecoin and there's stablecoin, right? So Tether USDT is not considered a stablecoin per se. So if you see it on the exchanges, actually it has its own price. So it'll have its own price against USDC and against TUSD, for example, right? And the reason that it has its own price is because people don't trust it, not 100%. You don't see the auditing, you don't see this, you don't see that. There's a few things here and it's very opaque and people just don't understand it, right? So the assumption is that it's not 100% safe. On the other hand, if you take a look at banks, right? There is no bank that can survive a bank run. There isn't one in the world. Like from the best bank to the worst bank, you can't, because the concept of a bank, the way the bank runs its business is by the money multiplier effect. So they
fractionalization, yeah.
Oh no, they get $100, they lend out 85. Right? Out of this 85, it comes back as deposits. Then they lend out at 70. Then they lend out. Then it comes back at 60. Then they lend out 60. So now basically you start with for every dollar you have that comes into the bank, it becomes 5. That's what the money multiplier effect is. So if all these guys came back to the bank and they're like, "Can I have my money back?" They have to unwind one by one by one by one. And if you don't have enough time, they don't survive that, and bam, it's all gone. Right? So that's why a bank will never survive a bank run. Stablecoin, on the other hand, is about duration risk. So a stablecoin, if you invest into a stablecoin's basic premise is that for every dollar that exists out there, I have a dollar here. But this dollar needs to work. So they will invest primarily in government bonds, for example. But if your government bond is 6 months, and this guy wants his money now, and you can't give back the money now because it's invested in the government bond, then you're in trouble. Right? So they're related in the same way as banks, because banks have that same problem, because like Silicon Valley Bank was invested in treasuries that were dated way out there, right? And that's where they lost money on the mark-to-market basis. But for stablecoin, it's a much shorter duration. There's no money multiplier effect. It's just that I need that $1 back, right? But if you can just wait for that $1, then it's fine. Now, Tether is different because we don't know how much they have, right? So currently, I think they have enough. But if you see everybody heading for the exit, right, or you think that everybody's going to be heading for the exit, you should get ahead of line first, right? Because if you tried to withdraw your money from FTX in the last 2 days, it didn't happen. But prior to that, it was fine, right? So this is again coming back to the nose. So if you have information coming to you, so last year I was fairly lucky. I mean, the only thing I missed was FTX. I kind of got too proud of it. I was like, it's FTX, it's FTX. Yeah, all this noise, it's going to be fine. So I had some exposure, not a huge amount of exposure, but I had some. But Luna, Celsius, all the other 3AC, I was on the phone with all my friends. I want to get out now.
I actually shorted Luna.
Oh, really? Nice.
Yes, I shorted Luna at $106 under the premise that the yield on Anchor Protocol was not sustainable. 20% yield. You look at the basket of assets that they have, Bitcoin, ETH. So I put in 50,000, made 2.6 in 5 days.
Wow.
So that was pretty good. And it was all under the premise of not chart reading, but fundamentals, because when I put in the short at 106, it actually went up to 120.
Yeah.
Made sure I had enough liquidity to sustain the trade. But it made sense because everybody was relying on the yield, and it wasn't sustainable. And their TUSD, the stable coin, it was all sustained not by stable coins or by USD, it was sustained by a basket of assets. So I'm like, okay, if Bitcoin goes down, you can't sustain this unless they're shorting the market, which clearly they're not shorting the market. So I agree with you. You're under the same premise of nonsense. I got caught up with Celsius. I think I lost like 150K on Celsius. I was, and somebody told me, it was like, what people don't seem to understand with these yield farms or these places where you're putting in your money for a return is that you're picking up pennies in front of a freight train or in front of a truck that's about to hit you because you're just focused on the pennies. And I lost a little bit on FTX, but I made it back shorting FTT on Binance. So big fiasco. And since then, I've kind of been a little bit iffy about the market. I don't necessarily love crypto the same way that I used to because of what you were talking about. It's just money, greed, money manipulation. Back in the day, everybody hold hands, kumbaya around Bitcoin, and like let's hope that the big dogs come in. Talking about the big dogs coming in, we see the BlackRocks, the Vanguards, these ETFs. What is your opinion about these big money movers and these market makers, the people that really dictate how the ecosystem is run? What is your opinion on them getting in?
It depends on scale. Because it's like McDonald's. When they launch a product, they have to know there's tons and tons and tons of supply, because if they launch a new product, they're selling a lot of it, right? So if BlackRock gets in, for example, these guys are a treasury for the treasury.
Yeah.
Right. So they are, when we talk about scale, that's scale. They talk about size that is, the crypto market is not big enough for them. It's not. So for them to actually do this, they need to be able to get in and get out. And that means the regulatory environment has to be there and the market has to be thick enough. Because at this point, if you wield around a couple $100 million in the crypto market on trading,
you're moving it.
You're moving it. That's way too small for any of these guys to do it. So they have study groups, I'm sure, that are looking at it. They have traders that are ding-donging back and forth with a few $1 million just to have fun, right? And those guys are probably doing well, but they're fully aware that liquidity is an issue. So when I say liquidity, liquidity could be cash liquidity, right? So we saw that very much in the GFC. So bank rates, overnight bank rates went up because everybody needed overnight liquidity to cover their position.
Yes.
Right. So there's that liquidity. And then liquidity also, like, can I get out? So I'm trying to sell this stock and there's no buyers out there. I'm trying to buy this stock and there's no sellers out there. So then if I can only do one or two, it takes me 6 months to build a position. It'll take me 6 months to get out of that position. Right. So liquidity in terms of that, these are the two main things that we need to consider. And right now, crypto market's not big enough. So it is still a market for the enthusiasts, right? Which means that we're in early days, right? That means that this is really where I think potential is. Is it Bitcoin that's going to survive? Right? I don't know, right? But is the space going to survive? Absolutely. So if we were to pick the internet stocks back in 2000, for example, which ones would survive and which ones are not, right? Most likely we would get them wrong. Like 80% of them we would get wrong, right? There was AOL, what happened to that, right? So
most of them nuked 90% plus either way.
Absolutely. I mean, AOL was smart because they did they merged with Time Warner.
Interesting. Now, I want to talk a little about trading and like your philosophy on trading. I'm assuming you still do some sort of buying and selling on the side. Do you have your portfolios? Do you have your enthusiastic?
We always trade.
Yes.
But it's in your blood. It's a trader is born. That's my opinion.
I agree. I that's that's one of my things. It's like I always end up going back to the charts. I always end up going back to seeing what's hot. I'll give you one instance. So Meta, for example.
Mm-hmm.
Most of the revenue comes in during Q4. Why? Because most people spend their money on ads during Q4. It's only logical. So when they were down, I think in October, down at like $85, $90, I put out a tweet and I was like, hey guys, I'm putting 10% of my net worth into Meta stock. And what's the premise? The premise isn't that the chart is too low, too high, it's down 80%. It's that when they announced their earnings in Q1, based off of pattern recognition from the past of how Q1s perform because of their reporting of Q4, the stock is going to pump. So 86, now we're at like 275. What is your philosophy of trading? Are you looking at charts still? Obviously, probably not the same way, not the same philosophy. There's people here that are listening that trade. That's their full-time job, whether it's shit coins, meme coins, Forex. There's some Forex guys. There's people that are in options, stock market, whatever it may be, crypto. What is your philosophy on trading? What is some insight and advice in this game?
I would say that what I believe is the only reason things go up rather than down is because there's more buyers and sellers, and vice versa. So that sounds really, like I'm pushing aside the question. But it's not actually, because if you think if you think that you can overanalyze a thing and you can say, oh, fundamentally it's like this, accounting is like that, whatever, like this is what it is, you're fooling yourself, because if everybody else doesn't realize it, it doesn't make a difference, right? So something might be fundamentally great. Like I used to love Intel stock, right? Because they had this great tech, but nobody knew about it. So if nobody knew about it, why would anybody buy this stuff? And why would anybody buy Intel, right? And so Intel languished for years, and it drove me nuts. So then, as opposed to, let's say, a friend of mine, he was telling me he was choosing at one point between this one company that was going to come up with this cancer research that was going to help, this medicine is going to help hundreds of thousands of people. It's going to be moving cancer cure forward by many, many, many years. And this other company that's coming out with an erectile dysfunction drug. I'm obviously going with cancer. So he didn't buy the Viagra company, right? And that pumped. So what you have to do is you have to think about buyers and sellers. So in your context, if you're talking about Meta, I think along those lines. You think psychologically speaking, why are things happening now? Why are things happening later? What is a causality? So you have to think causality. Like you have to think about, what is this going to instigate to that? How is that going to move to this? So I always tell people that you put 10 people in a room and you make them wealthy, right? They will all act differently. But you light a fire in the corner, they will all head for the exit. So what you want, or you want discrete, very guttural emotions to follow, because you can do that. Fear and greed are these two primary motivators when you trade, and you have to kind of go one
How do you
against the other.
gauge them? How do you gauge that? Do you gauge that on a personal sentiment? Do you gauge that on an understanding of, I don't know, social media? Do you gauge that on an understanding of where the market is? How do you gauge greed? How do you gauge fear?
So there's I think that when you look at money, you look at it in terms of like the sea. There's tide, and then there's waves, and then there's ripples, right? And you have to take a look at the different things. So in general, I think that interest rates make a big difference in the overall environment. We need to take a look. Interest rates are on the higher side. They're not ridiculously high. So if interest rate went up another 4 or 5% from here, we would have problems, because everybody would be scaling back, because the thing is that people couldn't afford their mortgages. And now we're having a very base problem over here. At 4 or 5%, it's still difficult, because actual mortgage rates in the US are higher. So people are paying 7, 8%, for example. That would be quite normal to pay for mortgages there. That's putting a significant strain on people's finances. That gives them less money to then go out and spend for day-to-day needs, right? And for trading. That then translates to less money going into restaurants. And these guys SMEs have loans as well that they're actually paying more for. So a higher interest rate market is going to be a belt tightening exercise, which is what the Fed wanted, right? They wanted to scale back demand in order to rein in inflation.
Do you think that this is a preconceived system? Like, because you don't just go from 0%, anybody can pull out money, tens of trillions of dollars flooding the system, to then tightening things instantly. Is there some sort of discrepancy here? Is this planned pre-head, in your opinion? How does your understanding of these decisions dictate your perception as to whether this is good for the populace at a macro level, or if this is a few people saying, okay, I can play the game?
Well, the Fed has limited tools to it, right? So it can change the amount of debt that's out there and the price of it. That's basically it, right? And so this, do you ever watch Mandalorian?
I have not.
Okay, so there's this one scene. Basically, Grogu, the little Yoda, mini Yoda, right, is sitting in a robot, and this robot can talk, right? And so he's communicating, but it only has yes and no, and that's the only two words it has. And somehow we can actually give a lot of information by just saying yes, or yes, 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 or no, 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 no. But basically, the Fed is almost the same thing. They have such little tools. They have 2 buttons, right? And that's all they're trying to do. And they're trying to finesse an extremely complicated system that is primarily based on the US dollar, on what they have with 2 buttons, right? And they're doing a damn good job given their limited resources. But you would think that they would come up with more buttons, right? Because the fact is, actually, people don't understand that the US dollar is the underpinning for the entire world economy. Because if you think about it, at least 60% of world reserves, of central bank government reserves on average, is in US dollars.
Yes.
Right? And then if you take a look at that, why is that the case? Because if you are a central bank and you have money sitting in your reserves as foreign currency reserves, you can't keep, just currency. Because if you kept currency, let's say you kept US dollars by itself and you put it in a bank, you can't, because then you take the bank risk. So as a country, you cannot do that. So you have to buy something that's secure. The only thing that's secure is are US treasuries. And US treasuries is US debt.
Yes.
So the entire thing holding it up is the fact that somebody owes us a lot of money, right? That's the whole basis of this entire thing. But it is treasuries that hold it up, and it's the only liquid asset out there that can support this amount of buying, right? So the US dollar sits there in treasuries, right? As world reserve, 60% of the world, right, sits there in US treasuries. Now what happens is, as the world gets better, as the conditions get better, you'll find that the US dollar weakens. Why does it weaken? It weakens because people who are already, they start as US dollar as their base, they divest away from their US dollars to buy, pesos, to buy euros, to buy Thai baht, to buy Vietnamese dong, whatever it is, right? They're buying it, the dollar weakens. Now, when the world turns and it becomes negative, they lose money. And now they need to settle. So then they sell their assets and they bring it home. And when they bring it home, the dollar goes up. So in times of real strife, right, when that fire is lit in the room, right? The dollar is king. So what we have to do is when there's a general panic, all asset prices go down, right? But when we say asset prices go down, what we actually mean is
The dollar's going up.
yes, because it's relative. Going down to what? Against what? You know, it has to be one to the other. So it's the dollar that goes. So if we could find that, you find that tool. So what you need is you need a broader panic. You need broader macro things to happen. And when you do that, then you know the dollar is going to be king because every asset is going to go down from real estate to gold to crypto to equities to other currencies. You name it, everything goes down. And that's exactly what happened in GFC.
Talk to me about all this echo in these emerging conversations of BRICS, the yuan becoming the new superpower of the world as the main currency. Clearly, people that mention that don't really understand how yuan is a closed and captive ecosystem inside of China. They're talking about the dollar going to zero. What is your opinion on BRICS? What is your opinion on the U.S. losing its world reserve status, which eventually it will be? 200 years ago we had the what was it? The British sterling, I think it was. But at some point there's things that shift. What is your opinion on the conversation there?
It's dangerous because the U.S. dollar is still so for years they promoted it, and that's why oil is denominated in U.S. dollars. And this is a key thing. So when they supported Saudi Arabia, right back in the day, they said, listen, the condition is that you denominate oil in U.S. dollars. And because it was U.S. dollars, everybody needed U.S. dollars to transact oil, and oil was needed, especially back then. We had no solar. We just had oil, right? So the U.S. dollar is there, but the U.S. has done a couple of things in the last 2 years that is worrisome. Because everybody knew that the U.S. had power, right? But the U.S. never exercised it. So what did they do? First, they took Afghanistan $7-8 billion. They said, you know what? We decided that you're illegal, we don't like you, and we're going to take your money because it's in our currency, ours. And then for Russia, when they invaded Ukraine, they didn't default on their notes, right? What they just said was, we won't allow any US dollar payments to anything to you. So we're happy to pay you, but can you give me a bag? Oh, I remembered. I had to shut it down, right?
Financial war.
Exactly. So US exercising this is terrifying for everybody else. And this is something that we have to be aware of because the US, by fact of the matter that we hold their money, is threatening us. So if I owe you $100,000, right, then you have power over me. If I owe you $10 million, and that is, let's say, 90% of your wealth, I have power over you.
Yes.
Right. And so that's essentially where the US is right now. The US owes so much money to the world that everybody's terrified. So this is kind of like everybody is kind of, unhappy about the situation, and I think it's only feeding into world politics as we are right now. Is it going to be solved? No. I mean, is any other country going to be better? Look, I mean, I may have my problems with the U.S., but I similarly would have my problems with China, and I similarly would have problems with Russia. I mean, do we want Putin to be, in charge of us? I mean, let's say he lasts the weekend. But it's what we have other things that I don't think there's better or there's worse. It's just either A or B. But I think that everything has its pros and everything has its cons. So the U.S. being there, is it going to be around for a long while longer? It will be, because it's hard to get out of the system. You need a liquid system. You need debt, right? And you need debt that people are going to buy, and you need the payment system around it to actually work. I think China can do it technologically, right? But not everybody likes China, right? I mean,
China doesn't like everybody.
The Chinese are Chinese, right? They have their own way of thinking.
You mentioned there's a lot of people that they run their businesses. They make dollars. But dollars are debt. People don't understand this. But debt to who? Or debt to what? So when the dollar is like, okay, let's go mint $1 billion. What is this loan process? What is this debt process when we have 4 or 5% debt or inflation? Who are we paying this interest to? Does this interest go to? And who is the ultimate beneficiary at the end of the day that has the bucket under the leaking faucet, just collecting those interest payments? Is that an organization? Is that a group of banks? What does that kind of infrastructure look like that we pay into?
So if you're talking about U.S. debt, then it's a government debt. So the U.S. debt would be coming from the central government itself, and then you have agencies like Freddie Mae and Fannie Mae, right? Freddie Mac and Fannie Mae, which have to do, let's say, with student loans or real estate related, right, in the U.S. So that all falls under that thing, and basically they are running at a deficit, meaning that they spend more than they receive. So they spend a bunch on munitions, for example, and they don't get enough on taxes, right? So what they do is there's an imbalance there. And so then they have debt. Now they owe money. Then what happens is, as let's say the Singapore government, for example, the Singapore government would have, let's say, $1 billion of surplus as a government because it's receiving more money than it's spent. We'll say, okay, and we have certain amount of reserves. What we're going to do is we're going to buy US dollar treasury, right? So now because you owe me money, but then you're paying me interest. So Singapore technically is the beneficiary of that interest rate, except that the U.S. debt keeps going up. So what they're doing is they'll say, I owe you money, and now I owe you interest, and now I just owe you interest. Now I owe you more money. And so then basically they're recycling it back and forth, right?
Because you're just recycling it with the US dollar. You're just paying off the debt with more debt.
Exactly. So that's exactly what it is. And can you stop it? Because as I said, now I owe you $10 million, and that's 90% of your wealth. Can you come to me and say, I want it now? Say, okay, you won't get it. Then you're broke.
Crazy.
Right.
Let's go back to exchanging pearls and
Exactly.
cows.
Because the thing is that we went off the gold system because we couldn't have money multiplier because of it. So gold, the Bretton Woods Agreement, which abandoned gold, was really on the back of the fact that, so from the beginning of time until today, you know how much gold has been mined out of the ground?
No.
Yeah. Take an Olympic-sized swimming pool, about 3.5 pools.
Wow.
That's from time beginning until now, that's how much has been taken out of the ground. Can you imagine supporting the entire world economy on that amount of gold? It's too little, right? You just don't have enough. So you need something that can grow, right? And so then what you need is, you need money, you need fiat, which is like, it's this fake thing. So, like we talk about Ponzi schemes, we talk about Luna, we talk about Celsius. Like, in concept, they weren't wrong because currencies went through the same thing. They just didn't hang on, or they weren't big enough. One or the other.
No liquidity to sustain the runs.
Right. But in reality, fiat runs in the same principle. It's exactly the same principle.
Is that a good thing or is that a bad thing? You look at FDIC insurance. FDIC is insured by the faith and good credit of the United States of
Correct.
America. So if everything is based off of faith, right, which is one of the keys for money, right? There needs
Correct.
to be trust. I was reading Julius Caesar, and when he basically started getting rid of the laws of fractionalization, he eventually got killed 4 years later because you had the gold standard back in the day, but then you had the silver standard, and then they no longer had any more empires that they could conquer to extract gold from or silver, so they needed to start adding iron ore to the coins, but eventually it imploded. So does the fiat system at some point just reset and everybody goes broke and some people hold on to the wealth and you just reset the system? Is that the fiat system that we look at? Because it's kind of hypothetical.
No,
Or
actually,
does it just translate?
actually, what you said is exactly right. So Thomas Piketty, he won some sort of prize, I remember. You've heard the name, right?
I haven't.
So Thomas Piketty, he's a French economist. He wrote this book called Capitalism in the 20th Century. And basically, he's talking about that. So his concept is this: wealth grows, and overall wealth grows. But what happens is the wealth primarily goes to a very small segment of the population, right? And so eventually, you get to the point that this is huge amount of wealth, and it's concentrated primarily in the top whatever percentage, like point something percent. And then people get really angry because 99.9% of people have nothing, and 0.1% has everything. Then obviously the odds are against you when that kind of situation happens. And then something foments, and then you have war. And then you have a world war, and then all asset prices go back to zero, and now we have the great equalization. And once we have great equalization, then we start again, and people are calm as we start to build wealth, and we come back. It's a cycle. So this has happened in the past, right? So World War I, World War II, right? So every great war in the past has actually been predicated by this wealth disparity. So that was his premise for the entire thing. So currently we have 8 people in the world that have more money than the bottom 50% of the population,
Crazy.
right? So if that's the case, like we're getting there, right? And if that happens, if what you're talking about happens, it's not about, some asset is destroyed. Everything goes.
Everything gets
Because if we
nuked.
get to war, right, now we reset. It's a great reset. So can you bet for that? No. Like that's then your best bet if we're going to go to nuclear
If
war.
one's fucked, everybody's fucked. That's kind of how I see it.
Exactly. So if the whole monetary supply shrinks, and then your best bet is to if nuclear war breaks out, you need to buy some goats, you need to buy some guns, you need to move somewhere in
Patagonia.
somewhere like that, right? And so that's not really a bet, is it?
So you just got to kind of wing it. That's,
You gotta wing
that's the
it,
name of the
right?
game. You don't know when they reset the servers.
Exactly. So you're all live and die together. So that's not really a bet to play, because if that's the bet, you can't look at the market and say, oh, I'm going to buy this, I'm going to sell that. That's not a tradable position, right? So if we're going to talk about practicality, that's what we should be talking about. How do you position yourself? Do you buy the dollars? Do you sell this? Do you buy that? Guns and goats?
I'm going to get you a t-shirt.
Yeah, that's
Guns and goats. I'm going to get you a t-shirt next time I see you.
That's a different website.
That's so good. Talk to me about this concept of preparing yourself. You talk about preparing yourself for the future. You talk about money being transferred to the top. It's not by causality that it's transferred to the top. It's by design. The system is designed to move the money upwards. I often say back in the day, Latin, with the Catholic Church was the language of the elite, because in that way you could read the Bible and you could translate it down to the peasants. Today, I say finance is the language of the elite. If you understand finance, you understand how the world works, because we live in a financial ecosystem. For people listening, entrepreneurs making some money, they think it's all about money, but they have no financial literacy. Talk to me about the importance as an entrepreneur to establish financial literacy, and what financial literacy actually looks like in a practical way today.
So financial literacy, I think, comes in many guises. I think it's not a simple thing to say. So for example, if you're really good at buying and selling stocks, right? It starts with a stock. Maybe you're really good at buying, selling Apple, right? So then you know where Apple is, and you know the company backwards and forwards, and you have a good sense of what, you're paying attention to, Mac rumors and all this other stuff, and you're figuring it out, and you're good at it. So it starts with one. Then maybe sector when you go tech, then maybe market, you go US, right? And then that's liquid. And then you start moving out. Okay, so then if you're a sector, then what about tech in another part of the world, Taiwan, but then you're dealing with it. So it's myriad. And so you can learn how to, and that's just stocks, right? So you start to read analyst reports. And then if you go from stocks, then you go to bonds. You go from bonds, you go to, then there's many classes of bonds. And then there's a foreign exchange, and then there's derivative products. So there's no one person that's an expert in everything. It's very, very rare. You need to work with a group of people that can give you access. So because not every asset class will do well. Like commodities, for example, is a very niche class, right? And hardly anybody we know, hardly anybody is actually well and truly in that asset class. And if they are, they tend to concentrate on things like oil, right, or gold, right? So then you have that. What you need is a network of people that you have access to, that to know, all right, I think there's an opportunity popping up in that sector. Right. So then you come down there and you do that. And I think this is the value of something like Capital Club, because you have that network. And so the ability to actually get that information up front and, in early days, like subprime in 2008, 2009, I smelt it, but I didn't know why it was going to happen. I didn't know that it was going to come from subprime, but I could tell that there was a high level of leverage. I could sense that there was something about to crack. Like I had a good sense of smell at that point in time. The thing that clued me off was Indonesian government treasuries was trading like 5 basis points away from US treasuries, which makes no sense. Indonesia is not as safe as the US, right? So you can't have it there. So I looked at that and I said, there's something really wrong with this. There's too much leverage in here, right? That's why everything's so expensive. And so something is going to crack. I don't know where it's going to come from, right? And I started divesting from everything. In the beginning of 2008, I'm like, sell. And I was selling like crazy, right? So the same thing is here. So that's the first part, is understanding the basics. Like what is going to happen? So you understand where the opportunity comes from. Now you have to go to the next stage, and you have to think about settlement, like execution. How do you execute this idea? So, okay, I want you to execute this because I need this instrument, right? So if like subprime, the guys, if you watched The Big Short, right, it was all about, the CDSs. Like he bought CDSs, he went short the subprime, he did this. Like those instruments are not open to regular people. So if you know what you want to do, you still cannot execute. Like, how do you execute this thing? So I looked for a good 7 months for a product to do because I felt that this thing was going to happen. I couldn't execute a product. So I was with my clients and we were looking for something to do. And I knew that this was going to happen. I knew in my heart of hearts. I said, this is going to happen, right? So we're going to demonstrate this as a long dollar, short everything else. But I wanted something that was going to do something a little bit more that was directly in the credit space, and I couldn't find it. And I was in banking, right? I was there, right? So I have access more than 99% of the people, and I still couldn't find it. Then the third part is settlement, because eventually I did find somebody who was going to structure something for me. It was Lehman.
What a joke.
So that would have been great, I do the trade, I made $200 million, and we lost money.
That was the settlement part is exactly my opinion because, for example, when Luna went to zero, I'm like, okay, when it goes to zero, there's no liquidity left, so I need to exit before zero.
Correct.
So this premise of, okay, 2 to 30 million, yeah, that discrepancy of selling at that $10 mark as opposed to a $0 mark, yeah, theoretically you make more money, but you can't get out of the position.
Correct.
And that was the entire premise for that. Going back to your career, you move away as CEOs of CrossBridge.
So the last stage after settlement is you need to then structure. So that's a final piece, because the thing is that you've gotten your gains finally. So you've gone through you've identified your opportunity, then you've executed it. Now you've taken your money out, right? And the final stage, you got to put it somewhere where it's going to stay safe. And so these are the stages that you need to go through for that.
In Capital Club, we teach the creation of wealth. So that can be through running a business. It can be through multiple different formats, having a good salary. We talk about the multiplication of wealth, which is finding opportunities in the market that are going to allow you to multiply your money at a higher speed than the amount of time required to invest it. But very rarely do people talk about the most important ingredient of wealth, which is the preservation of wealth, which is exactly the last part of your equation, which is kind of where you've established your expertise at this point, is how do you preserve all the years of hard work that you've actually put in? So you move away from CrossBridge Capital as a CEO there to now being a node in an ecosystem. What are you focused on nowadays?
Well, there's still, I mean, the first three parts are still pretty fun. So I still enjoy doing that, right? Sure. But as you were saying, as you're asking last, it's how do you find out this information? Because, trying to find out which asset class is important to invest in. I think a lot of people spend a lot of time there and they don't think about the other parts because relatively speaking, it's much more boring, right? But you need to reach out to the same network. You need to reach out to all your nodes. And Capital Club is really good for that because you have that. And what you do then is you go in there and you find other people to help you out on the next three stages, right? So if you're lucky enough to figure out what the right asset is, then execution, settlement. And the last stage, you're right. It's very few people get to that point, right? Very few people get to that point. And I see a lot of people lose. So, I mean, I've seen clients that spent their entire lives, in a business and they've been successful at it, so they made hundreds of millions of dollars. And then they walk into a bank, thinking the bank, are people that they can trust. Then they invest in banking products. And then they walk away and they lose 50, 60% of their money because they listened to the wrong person. So that last piece is so important because by the time you get to that last piece, you're no longer young, right? When you're satisfied, right? Okay, never mind young. You've gone through a successful trade. Now you've gotten your $5 million or $10 million and it's a large sum of money. Now you want to put it there. And let's say you put it into Silvergate Bank. And then it all goes bye-bye, right? So you need that last piece to preserve it. And that is so important. It comes later, but again, you have to go back into the network. And your preservation is not only about which institution you put into. It's about because you want to earn money on it, right? So you definitely don't want to put your money into a safe place and then invest into 3AC, right, for example, because that's an investment. That's not actually capital preservation.
Correct.
You have to separate the two. You should think separately about that. You need to think about your tax considerations because maybe you're going to move, right? So today, let's say you live in a relatively benign situation. For example, let's say you live in Hong Kong, but then maybe 5 years later you decide that you need to move to the U.S. or you need to decide you want to move to Europe, where there's completely different tax considerations. So you need to structure yourself to have that longevity and think ahead, because the idea is that we're not going to die tomorrow.
Mm.
Right? If that's really what it is, seize the day, carpe diem, go out there, let's put some neckties around our head and invade the capital, right? So that's not, but that kind of thinking doesn't really carry you past tomorrow, right? We need to think about that, because eventually you're going to have people that you need to take care of, right? That's the idea, as whether it's your own personal family or it's your tribe, right? Maybe it's going to be other people in this your network of friends. There are definitely people as we get older that we're going to care about, and are going to care about us. So what we need to do is we need to have those considerations. Earlier, the better.
Talk to me about what that looks like nowadays for you. Are you focused more on helping entrepreneurs structure organizations, structure themselves out? Are you more involved in the process of advising where that money actually gets placed for preservation? What's kind of the focus nowadays?
Well, it's a bit of everything, because people are at different stages. So some people want to invest, some people want to receive investments, some people need to figure out a right way to actually execute it, and then we got to figure out exactly how we're going to get paid for it, right? And then we have to figure out the last stage. But the one thing I'm doing is that I'm helping at all three, because I've made a lot of mistakes in my life. Right. As I said, adversity is the reason that one becomes stronger and better. I'd like it that my friends, right, and my associates don't necessarily have to go through the same pain, right? And that's where I give back, right? So if we can actually structure these things, and I'm not talking about like, oh, you need to buy this stock or you need to buy that company, right? That's not what I'm talking about. It's about a process, because I can be wrong, right? I can say you need to buy oil, or you need to. There's a chance I'm going to be wrong. I'm never going to be right about everything all the time. So I'm not an investment guru in that way. Right? But what I'm going to do is I'm going to say, if we put a process in place, if you have the right investment, you will get out of this and you will do well. Of course, it's a bad investment. It's a bad investment. There's nothing we can do. And failure is part of life, right? It's just try to fail less and try to make your successes more than your failures.
It's like trading.
That's exactly what it is. You can never get all trades right. It's impossible.
Yes.
In fact, I love to show off about my failures more than about my successes.
Tell me about failure. The biggest L that you took in the markets, whether it was personally or whether it was at a corporate level, because you said there's some badges of honor. So I want to flash one for me.
I mean, at one point when I was at JB, the position sizes we have in the majors were significant, like really significant, and we managed to pull quite a lot of money from the markets during those 2 years. I can't tell you exactly on a recorded format, but it was significant. And one of my clients decided that he wanted to, he knew better than us. So there was an event in the U.S. It was QE2, so it was their second time of doing quantitative easing, and he decided he was going to sell the dollars. And I said, that's the wrong move. You need to buy it. And he goes, no, you need to sell it. So we turned a $500 million delta position, which actually meant we moved around $1.5 billion worth of options to turn this ship. And we got hit right in the face. So that was a big, big loss on that day. Multi 10 millions.
Oof. Wow. Now, wrapping it up, I want to take it more into the philosophical side. I want to talk about some of the foundational principles that have carried you through your professional career and now your entrepreneurial journey that stand true throughout time. So what are some unwavering principles or philosophies of life that you stand by regardless of anything that's happening?
Stay honorable. I think that always stands you in good stead. If you walk away from, if you rip somebody off, for example, that will follow you for the rest of your life. It'll come back, right? I do believe that karma comes back to you in that way. So if you do the best you can with the best intentions, right? As long as your intentions are good and you explain that to people, then I think that people are willing to forgive anything, because everybody will make a mistake, right? Nobody is perfect, right? That's why, God is God and we're people, right? Because there's, we're not a different being. So yeah, be honorable. I think that be be honorable, and then it doesn't necessarily mean that you're honest all the time. It doesn't always mean that you're. It doesn't mean all these other things. But if you do it for the right reasons, and you're honorable, and you do it for the sake of helping people, like you tell a person a white lie in order to try to make him happier, right? But it doesn't change any outcomes, But you're doing it for the right reasons. I think that
Like,
that's
hey, you look nice today.
correct. That's exactly right. That's exactly right. Something like that, where I think that is good, right? And then if you do that and you stay in that vein, you don't hurt people. And if you don't hurt people, then your karma is good. And I think that at least you're a better human being at the end of the day. And if you play your game well, you'll enjoy it. And if again, as you enjoy it, then you get the benefits.
You get the rewards. Last question. As we wrap up, what is one principle or piece of advice that you would leave to the members of Capital Club that are listening to this session?
I think that use the network. I think that what you have here is very, very, very powerful. I'm very glad that you asked me here today, because I get to participate in this community. But this is a very, very powerful format. I think that once you have this, you have the ability to actually move markets, right? Because I was able to move markets in my early 20s as a single entity. I think you have, with the number of members that you have and the clout, and as the group gravitas grows, I think that your power is going to be significantly more. So, like Spider-Man, with great power comes great responsibility.
Uncle Ben was a wise man.
That he was.
Mr. Yai,
Pleasure.
thank you so much for coming on. It's been a good one. Ladies and gentlemen, that was another episode of Money Talks, an exclusive conversation with some of the most brilliant minds in business, entrepreneurship, and finance. Hopefully you guys unlock some data sets and some value just as much as I did. And I'll see you guys on the next one.